In the mid-1800s, long before computers, central banks, or modern finance theory, a quiet American farmer sat down with nothing more than handwritten price records and a single, dangerous question. What if markets are not random? What if financial booms and busts follow a rhythm, not driven by charts or indicators, but by human behavior itself? That man was Samuel Benner. And the cycle he documented nearly 150 years ago is quietly pointing toward a critical window in 2026. Not a prediction. Not a prophecy. But a historical warning. Today, global debt is at record highs. Central banks are trapped. Geopolitical risk is accelerating. Confidence in institutions is thinning. And once again, markets are behaving exactly as they tend to behave late in a long cycle. This video is not about fear. It is about preparation. Because history rarely repeats exactly, but it rhymes more often than people are comfortable admitting. Who was Samuel Benner? Samuel Benner was not a Wall Street insider. He was not an economist. He was not selling a system. He was a farmer who lost everything during the Panic of 1873, one of the most brutal financial collapses of the 19th century. Instead of blaming bad luck, Benner studied history. He collected decades of price data across commodities, land values, and credit conditions. What he found shocked him: major booms and busts appeared to occur in clusters of time, not randomly. In 1875, Benner published Benner's prophecies of future ups and downs in prices, outlining a repeating cycle of market behavior. His claim was simple but radical: markets move in repeating time patterns because human psychology, credit expansion, and speculation repeat across generations. The core structure of the Benner cycle: Benner identified several recurring time rhythms, but three matter most for modern markets: an 8 to 9 year cycle, short business stress; a 16 to 18 year cycle, structural market turning points; a 30 to 36 year supercycle, system level resets. These cycles were not about exact dates. They were about windows of vulnerability, periods where markets were statistically more likely to change regime. Importantly, Benner focused on turning points, not trends. The cycle does not say markets must crash. It says something must change. Why time matters more than price. Modern traders obsess over price. Cycles obsess over time. Price can be manipulated. Time cannot. Every major financial collapse in history followed the same progression: credit expansion, asset inflation, confidence peak, policy distortion, structural stress. The only variable is how long it takes. Benner understood this intuitively. And this is where 2026 enters the conversation. The 2008 anchor point. The global financial crisis of 2008 was not a recession. It was a system failure. Banks collapsed. Credit markets froze. The global financial system nearly stopped. The response was unprecedented: zero interest rates, quantitative easing, balance sheet expansion, moral hazard institutionalized. 2008 was not resolved. It was postponed. Add 16 to 18 years to 2008. You arrive at 2024 to 2026. That window matters. Why 2026 is a structural turning window. According to Benner logic, the 16 to 18 year cycle is where debt saturation becomes visible. Asset valuations lose credibility. Policy tools lose effectiveness. Market leadership rotates violently. By 2026, governments face refinancing walls. Central banks face credibility tests. Demographics turn restrictive. Geopolitical risk intersects with economic fragility. This is not coincidence. This is late cycle behavior. The COVID shock accelerated the cycle. COVID did not create new problems. It compressed time. Trillions were printed. Rates were suppressed. Markets were artificially stabilized. This pulled future stress into a shorter window. By 2026, markets are no longer debating inflation. They are debating confidence. Debt, the silent constraint. Global debt now exceeds $300 trillion. Debt is manageable when rates fall. It is destabilizing when rates rise. The Benner cycle consistently aligned major turning points with debt stress. Debt does not collapse markets overnight. It erodes flexibility. By 2026, flexibility is gone. Why this is not a crash call? Cycles do not predict crashes. They predict pressure. Pressure produces outcomes. Those outcomes may include volatility, repricing, policy realignment, institutional restructuring. The danger is not collapse. The danger is complacency. Asset behavior in late Benner phases. Historically, stocks show leadership rotation. Bonds lose their safe haven role, commodities regain relevance. Currency confidence fractures. This does not mean panic. It means selection matters. Why institutions fear cycles? Institutions prefer narratives. Cycles expose limits. They suggest no policy lasts forever. No expansion is permanent. No dominance is guaranteed. That is uncomfortable. The psychological component. Every cycle ends the same way, people believe this time is different. It never is. The Benner cycle is not mystical. It is behavioral. Preparing instead of predicting. Preparation means understanding regime risk. Reducing fragility. Avoiding leverage. Thinking long-term. Prediction invites arrogance. Cinematic closing. In 1875, Samuel Benner warned that markets move in waves shaped by human nature, not technology, not intelligence, not policy. A century and a half later, we are more advanced than ever. And yet, the cycle remains. 2026 does not promise disaster. It promises consequence. The question is not what markets will do. The question is whether you will recognize the cycle, before it recognizes you. History does not whisper. It repeats.